Now let's understand the concept of component depreciation through an example. Suppose the cost of an asset is $500,000 and we have identified five significant components: C1, C2, C3, C4, and C5. And the cost of each of the components is $100,000. However, the useful life of each of the components is different. For example, C3's useful life is 2 years. However, C5's useful life is 10 years. So there is a difference in the useful life of each of the component. The first scenario is these we have depreciated the asset on a straight line basis over a period of 5 years. No component depreciation has been done. We depreciated the cost of the asset over 5 years. There is no concept of component depreciation. Then in such a case, the amount of depreciation for year one would be $100,000. Now, see $100,000 from another perspective is that we have accumulated a cash fund of $100,000 to fund our future purchase of property, plant, and equipment. However, if we go by the component depreciation concept, the funding requirement is $115,000 rather than $100,000 because there are two assets whose cost oh sorry there are two assets whose useful life is less than the suggested useful life that we have taken for 5 years for an asset as a whole. For example, component number 3, where the depreciation amount should have been $50,000. However, we've only saved $10,000 out of $50,000. So there's a deficit of 40,000. However, in case of C5, the savings should have been $10,000. However, we saved $20,000 in respect of component 5. That kind of an offset the requirement of the fund. However, when we see at the broader level, the total requirement for the fund is $115,000, but what we have saved is only $100,000 for the future purchases of fixed assets. So in order to mitigate these kind of funding a deficit or funding mismatch, an entity is required to apply the concept of component depreciation on an overall basis to fund their purchases on fixed assets.